Jordan, very good to see you. Today, we get to discuss how to minimize capital gains tax. So, we're going to talk through 5 strategies that range from timing to charitable giving to certain investment techniques. So, let's start by explaining when you are on the hook to pay capital gains tax. What do we need to know?
Yeah, so that equates to those accounts that are tax non-qualified accounts that are taxed every time we trigger a gain, whether that be selling a large stock holding or maybe get a little bit of interest in your money markets. Those are non-qualified accounts, which we call it taxable, or those accounts are taxed always each tax year. So we got to look at capital gains and how we can minimize that for your financial future.
Right. Okay. So now let's talk through those strategies then. And the first one is simply bite the bullet, pay the taxes now, because as we talk about all the time, Jordan, we are living in a historically low tax rate.
Yeah, a lot of people are considering paying a lot of taxes now because taxes are on sale. If we look at this chart, we see that taxes are historically at almost at all-time lows. And simple math will say that taxes have to go up. We have debt ceilings. We have all the stimulus that we haven't paid for, government programs. So some people consider paying the taxes now because it might be a whole lot worse in the future.
Mm-hmm. Next, you suggest we consider a donor advised fund. How does this work?
Yes, for those of us that are charitably minded and we like to give to charity, you can put money in a donor advised funds and get a tax deduction that adds to your itemized deductions that can minimize your taxes now. They can still grow, and then you can give to charities a few times this year, next year, or for decades to come. But those accounts continue to grow in that donor advised account, and then you decide when you kick it out to charity. These are going to become more and more popular, I think, in the next 2 years, because based on current legislation, their standard deduction is looking to go down in half, which means more and more people might be itemizing, which these might come into more in play.
Yeah, really good point. Another strategy would be tax loss harvesting. So how does this one work?
Yeah, so before the end of the year, December 31st, you might want to take maybe a few stocks or a few funds that have a loss. You might want to take some of those losses now so you can deduct that off of your tax return for the 2024 tax year. Now, there is some limits. You can only deduct up to $3,000 per tax year, but say you took a loss of $10,000 hypothetically. You don't lose it all. You can only deduct $3,000 for this year, but then you can carry forward the next $7,000 and deduct that for consecutive years. Or if you have a gain, you can offset that to make sure you don't pay any capital gains tax on that gain.
Okay. And next, we need to make sure that we hold the asset for more than a year. Why is that?
This is a big one. There's a lot of tax favorable treatment for long-term capital gains. And that means you have to hold the assets for just longer than 1 year, 366 days. So maybe you're thinking, oh, I got a gain. Let me sell before the year's over. But if you're at 364 days and you sell, you are paying a much higher tax bracket. Where if you hold a couple extra days, you get that over a year period, you might be paying a lot less, or potentially based on your situation, pay 0% on that capital gain. So it's crucial that you look at the tax plan you have and make sure on those non-qualified assets, you do wait at least 1 year before you sell.
And the last strategy would be to consider a charitable remainder trust, a CRT.
Yes, and these are so big and so crucial, especially if your goals are to leave to a charity and you're passing. You can minimize your taxes dramatically now and for years to come by putting the CRT, this charitable remainder trust. You get a huge tax deduction for the year you put that in, and you can carry that over a few years. And you can get income out of that trust for as long as you live, potentially. Then when you pass away many decades from now, whatever's left in that trust will go to charities of your choosing. So it's a way that you can benefit from the tax deduction now, still leave charities for the future. But the key is you have to know your goals. Is your goal to leave this amount of assets to a charity? If so, that's minimize the IRS tax burden.
Legacy planning. I love it. Jordan, you're always thinking one step ahead, many steps ahead. If somebody has any questions about how to minimize their capital gains tax, how can they reach you?
Yeah, we always say in our office, it's not what you make, it's what you get to keep. We'd love to help them minimize their overall taxes and have a tax plan. They can call our main number, 847-499-3454. And we can get together and see how we can help.
Great, Jordan. Thank you.
Thanks, Aaron.